Good afternoon. My name is Matt Doxa. I run a company called Excelsior Wealth Partners, and we are going to bring you today a 20-minute-ish type of segment that we like to take a few minutes and focus around financial matters, current events, what should our clients be investing in. So today we're gonna take a look at financial markets in the year 2022. That sounds like a pretty basic type of agenda, but when you have the volatility and the circumstances that are surrounding such volatility, then it probably is a good use of time to take a few minutes and say, okay, what's the game plan? What are we investing in? What should we be looking for, not only just today, but for the months and years to come? So I will say state of the markets, and I will also say what should we be investing in our portfolios. So if I look as we sit here, we are down on the NASDAQ. Perhaps some people use what they call, NASDAQ type planning, down, say, 14% as of the first week of March. Let's say the S&P 500 as an asset class down a little over 8%. Let's say some of the bond holdings that the U.S. government famously bought to kind of buoy, hold up these fixed income type of markets. Some of those holdings are down a little over 6% year to date in 2022, and that was coming off a negative year last year. So the world is different. We say a lot of times around here that it is not your father's or your grandfather's market anymore. The days of being up 10% and perhaps going on to the next thing. Nowadays, you see stocks that miss earnings, top and bottom, revenue, and they're down, say, 24% in a day. A lot of algorithms in the markets, less trading being done by humans, more by algorithms, which are tough to, I would say, quantify and predict. So if I say we are in a environment of high inflation, so inflation over, say, 7.5% on CPI, maybe over 10% on PPI. And this is, one of the first times we've had these low treasuries in a environment where inflation is so high. So let's go circa early 80s. Last time we had inflation running as rampant, treasuries may have been 14%. So, just a different world. Interest rates supposed to be going up. We're at zero. They almost have to go up. What are they going to go to? That seems to change daily depending on who you talk to at the Fed. Coming out of a once-in-a-100-year pandemic called COVID, where we printed a bunch of money, did what we could to kind of make sure we didn't go into another Great Depression of sorts. That worked famously. Those guys did a great job, and now they're trying to unwind it, and that is, not without its issues. So what I'm going to do, I have Jeff Dzwonkowski over here. I have Matt Champion, and I have our longtime contributor, Kevin Christopher, sitting here ready to tackle those two issues of what's the state of the market. So I'll go around one lap here, and we'll just talk about, if it's relevant, how this Russian conflict has kind of worked in, and then we'll do another lap after that around what should our clients be investing in, and then we will call it a day. Jeff?
I'll touch a little bit on kind of the change and what the Federal Reserve's been doing over the past decade plus or so. I think a lot of people have gotten used to what they call easy money. Federal Reserve over years really dropped interest rates down to zero. And since then, everyone's gotten used to kind of high growth stocks, great performance, things like that. It was, again, what they call easy money. Now you're starting to see a major shift with the Federal Reserve, coming out of, as Matt mentioned, the once-in-a-100-year pandemic, now trying to unwind all the money they printed. So they're going to have to catch up with all this inflation, and one of the big things they'll be doing over the course of this year and probably the years to come is rising interest rates. The matter of, it comes down to how much or how often they're going to be doing so, but typically what happens there is you start seeing a major shift from growth to value stocks, for instance, and you're starting to see that a little bit in the market here. I think Matt mentioned the NASDAQ's down 14%, which could become a big shock as people start getting their quarterly statements coming up here not too not too long from now. So major shift that we're starting to see here, and we're starting to make some changes, accordingly. The Fed's kind of showing their hand right now. So my personal opinion would be now is not the time to sit on your hands and, kind of wait. You've gotten away with it over the past decade or so. So starting to make the changes here, and that would be, one of the major suggestions we have here at Excelsior. And I'm going to pass it over to Matt Champion now.
Yeah, and I think, Jeff, you hit the nail on the head when you said, not time to sit on your hands. You hear that quite a bit with the when the markets get this volatile. A lot of people will say, people on TV or some of the clients we talk to that may have worked with other advisors in the past, the general consensus is always sit tight and the markets will come back. But I think there are moves you can make, which we'll talk about here in a little bit, during times of volatility that we're seeing right now. I think the other big thing that Jeff just kind of alluded to was that people got comfortable really over the last couple of years where there really wasn't a major pullback. I know right when COVID first hit and the economies got shut down, February, March of 2020, there was a little bit of a dip that people got nervous about. But really the market's rebounded well based on a lot of different factors. But since then, we've really been on nothing but an uptick until the start of this year. So I think it's kind of a wake-up call a little bit to say, geez, am I diversified enough? Am I in the correct sectors based on some of the things that are happening in the marketplace right now? Or, rather than just sitting tight and watching your portfolio go down, are there some adjustments that you could be making to try to combat what's going on right now? So, Kevin?
So I'm going to end up beating a dead horse here at this point, but what everybody else has said, as well as what a lot of people haven't done is reallocate, in the past decade. So if you owned the NASDAQ 100, you're up huge, and now you're giving a lot of that back. As well as there's a bunch of other positions. The S&P is up huge over the last decade. And a lot of people don't go in and quarterly rebalance and readjust. So your risk may be severely you might be taking on a lot more risk than you realize. And you're going to see it in your March statement for the first time since, the beginning of the pandemic, to Matt Champion's point. I'm going to hand it over to Matt Doxa.
So if I said the playbook historically is called for asset allocation, you seemingly ride out some of these peaks and valleys in terms of volatility. So if markets are down 10, just stay the course. That type of approach gets a little bit what I would call sideways if you are getting ready to retire this year. So if you lose 10%, you now need to get 20% plus to get your money back, and that becomes problematic. So, a lot of the planning we do here is around minimizing volatility and being in the right risk reward type of package. And most people, when we analyze portfolios, they don't fully understand the risk that they're taking. They don't understand the overlap in a portfolio, meaning they own Microsoft 10 different ways through 10 different mutual funds. They don't understand their fees. So we're able to put this all together as a nice package, but you have extenuating circumstances out there, right? So it's not the normal, hey, ebbs and flows, economies are cyclical, and you just have to, be on the right side of, the cycle, I guess is how I'd phrase that. So I'm going to spin it a little bit with that said to saying, hey, what should we be investing in? We're going to stop short of ticker symbols and specifics. So if anyone listening to this wants a portfolio review, we don't charge for portfolio reviews. We'd be glad to let you know what our latest, greatest ideas are. But, we're going to talk more about asset classes. So if I say one of these gentlemen might talk about, real estate, being invested in non-publicly traded real estate, we're not going to get into the companies or the holdings, but, just an asset class that's done very well so far this year and was a leader last year in terms of asset classes. But, that's really what we're looking for. And then more into the future. So, if you did a 60% equity, 40% bond portfolio, those bonds over these last year and a half might be down double digits And that might continue into the years to come as we raise interest rates. Again, I use the word problematic because we could get away for years of not having negative bond returns, So, and then the coupon rates, the yields are as lowest as they've been. So it's hard to get your money back just on a normal income flow. So all challenges that we deal with day to day. And then I'll send it around the room here to Jeff up first to say, hey, what should our clients be looking at during these unconventional times?
So Matt mentioned, the old school portfolio design of 60-40, 60% stocks, 40% bonds. You're starting to hear a lot of people talk out there, more of a 60-20-20 approach in terms of asset allocation. The 20-20 being broken up into less bonds, and even nowadays you have to be more specific with which bonds you will be invested in. But the other 20% being something like alternative investments. So alternative investments for us, at least over the past year and a half now, we've really leaned into things that Matt mentioned was non-publicly traded REITs. And the key distinction there is the non-publicly traded. For instance, publicly traded REITs on average are down about 9-10% as of yesterday, whereas the non-publicly traded REITs are up around 3 to 5% year to date. So a huge difference. And the main reason is the non-publicly traded REITs typically don't have to worry about the supply and demand of market. Publicly traded REITs are getting dragged down kind of with everything else, but the non-publicly traded REITs are, valued by a third party. So they come in and they take a look at all the properties, the comps, is everyone paying their the leases. So they've been performing very well, and the shift to that has been very helpful to a portfolio where the stock side of the clients' portfolios is hurting a little bit. We're able to prop it up with something like a non-publicly traded REIT. They typically invest in things that are not retail oriented, things like industrials, multifamily homes, things like that. And it's been really beneficial over the course of the past year and a half. And being able to diversify again into that 60-20-20 portfolio has really made a big difference from, I think we mentioned what used to be your grandfather's old portfolio and old market. So that's one of the, the big ideas we've had this year, and it's provided a good yield for the clients that are retiring. And also, whether or not your money is retirement or not, if it's non-retirement money, there's also potentially big tax benefits for the income that comes off of those non-publicly traded REITs. So there's a lot of benefits that come with it just outside of the performance. But that's been a big thing for us this year so far. And I'm going to pass over to Matt Champion.
And to kind of add to that, I think, the REITs, a big benefit is the monthly income that's generated. So one of the other areas that we look at in times of volatility, Jeff mentioned it earlier, you hear the term shift to value. A lot of times in rising interest rate environment, people will shift to value type stocks. And what we look for is dividend paying, not just any company that pays a dividend, because that doesn't necessarily mean it's a good investment just because it pays a dividend. There still could be some risk involved. But really in times that we're going through right now, your big, solid, blue chip dividend paying companies that have just been around a while, that you don't have to worry about them going under or getting hit as hard as some other companies. But the other thing that the dividend will help to do over the course of a year that we're seeing now is it can help to kind of offset the volatility in the underlying price, because again, if it's a big solid company, typically those dividends are pretty consistent. So, Jeff mentioned real estate. Another area to look at would be, the companies that I'm currently holding, are they solid? Are they dividend paying companies? Again, as it relates to that shift of value, I think as the Fed comes out and decides to potentially raise rates a few times this year, we'll see how it plays out with everything that's going on right now. But as that happens, the value stocks should be a little bit better off than your growth-oriented type stocks. So that would be something to consider is inside the portfolio. Do I have dividend-paying companies, and are they big, solid dividend-paying companies? Kevin?
I'm going to follow that up with, so Jeff has covered non-traded REITs. Matt's covered dividend-paying stock. I like the energy sector in general. That owning energy companies or owning the assets themselves, like natural gas or oil, or, as I said, the companies that produce these products. The reason being, again, most of them pay a dividend. Most of them are very large companies that have large, war chest. We're not worrying about like the tech stocks that are, there's earnings based value on these companies. So you're not in a position where you're hoping that they're profitable. These companies turn a profit every year. And I'm going to hand this over to Matt.
So just a comment of what may seem like a normal podcast type of topic is you have to consider that we've had somewheres of a 16-year plus bull run, leading into this year, 2022. And, you're up like 450 some odd percent. Don't quote me on that, but you've made a lot of money by being in the stock market as of these past decade and a half. Statements from 401ks were the highest value they've ever been as of December 31, 2021. So you got to keep in mind that we went through a correction of sorts, flashbulb in a cave 3 months, the beginning of 2020 when COVID hit, but everyone was so distracted about COVID that it kind of made sense that markets would be down. Nobody knew what the Fed was going to do, how we'd react. And then markets, pulled up, say, 36%. And finished up 18% from being down 18% in March of that 2020. This is the first time, gentlemen, keep in mind that the highest wealth in, Americans' hands have ever been put to risk by, something that's happening right now coming out of a COVID environment and, just economic wrangling and all the things that you're seeing. You can't go any lower than 0 on an interest rate, right? So once you go, last time we did this, it was 1%. We went to 5 over the course of 3 years or something like that. To be at 0, are bonds going to be negative for a couple, 2-3 years like they already are? Those are the questions that we have. So we do have answers. We use some different items like we just went through, non-publicly traded, covered calls. Again, we're not going to get into the specifics of what, but limiting downside with options, rotating sector. So the sectors that are in right now may not have been in previously. Let's suppose energy has been, struggled after a monster year a couple of years ago. Financials tend to do, certain financials do well when interest rates are to go up. So there's certain sweet spots. There's certain risk minimization. Nobody can even say that word, but you know what I'm talking about when I say it. Mitigation strategies. How about that one? Where you're trying to shoot for returns that are positive while minimizing the damage of a continued down market. So as we sit here, not having a crystal ball, we don't know how the Ukrainian-Russian thing is going to work out. We don't know exactly what the Fed is going to do in terms of when they're going to do it. So, interest rates are going up. We just don't know what exactly that looks like. So there is a lot of uncertainty. There are a lot of good strategies. The one thing that you get here at Excelsior is we're not trying to apply an old playbook to a new problem. I don't believe there's 2 humans on the planet that are qualified to say what happens when the United States government did what they did, coming out of a once in 100 year has been said pandemic, black swan event. I don't know that there's enough people on the planet that are qualified to say this is exactly what's going to happen in the future. So we're kind of learning as we go, which is kind of scary because, again, it's the backdrop of Americans having the most wealth on paper they've ever had. So, do you just ride it out and perhaps you're not on a retirement year? Maybe that's a strategy. Or do you partner with a firm like Excelsior that's giving you some different looks, different ideas, non-traditional ways to keep these accounts moving forward? Just food for thought. So, gentlemen, any final shots, any final items that are on your mind? Jeff, you have one.
I mentioned earlier, but now is really not the time to just be sitting on your hands. You got away with it for basically since coming out of the 2008 crisis. You really could have just put your money in the market and forgot about it. But you also have to remember that you were 10 to 12 years younger then, probably still putting money away. So if you are approaching retirement or in retirement, now is not the time to just hold. There have been several periods of times in the market where it's taken 6-7 years to even get your money back. And now that you are retired or approaching it, it's much tougher to kind of withstand that type of pressure on your portfolio. Different ballgame if you're younger, sure, but most of the individuals we work with here are retired or soon to be retired. So now's the time to kind of fine tune your portfolio. Make sure you got an investment team that's keeping an eye on this and making the proper changes, at least given what the market's showing us. So those are my final thoughts. And here's Matt.
Yeah, the only last piece I would add to that is be careful of the panic sell. Meaning, we have over the years we've had clients that try to time the market exactly, and they rather than try to tweak and look for different sectors that are in favor, they'll just sell out of everything, and typically they'll do that when it's too late. After they've already lost a good chunk of money, they'll sell out. They'll sit in cash. And a lot of times, it's really tough to know when to get back in, and you miss a lot of the rebound for when it does happen. So be careful of that, the all in, the all out type strategy. I think it's more about what we've been talking about, which is different sectors, different strategies that are still working, even with all the volatility that's happening right now.
And this is part of this is Kevin again, and this is part of an ongoing process. So if you're not seeing regular changes inside of your portfolio and tweaking and making adjustments, and you're working with people, what are they doing? Are they using funds and having managers do it? But I mean, some of this stuff has been telegraphed for a little while on what was going to happen, and if interest rates rise, there's certain sectors that just aren't going to do well. We've been here making changes since before COVID, through COVID to now. If you look at a portfolio of ours 2 years ago versus a portfolio today, there's very few holdings that are the same throughout there. There's probably one or two, but I mean, there should be constant adjustments as you get closer to retirement, and make sure that people are actually doing what you're paying them to do. Matt?
All right, gentlemen, we are at that 22 minute mark. Appreciate the thoughts, appreciate the analysis. As always, we try to bring a couple of quick, hard-hitting ideas that you can implement into your current financial planning. So hopefully we've done that. You can always outreach to us, Excelsior Wealth Partners, and we could certainly go more in depth into some of the ideas that we had talked about today. So with that, I wish you all the best, and we will wait to hear from this panel until our next podcast. Appreciate it. Take care.